Private equity may be kicking the tires on Twitter. A source close to the matter tells Yahoo Finance Apollo Global is looking to help finance a deal for Twitter. Reports also say other private equity firms are showing interest in potentially buying Twitter outright. We should note Apollo Global is the parent company of Yahoo Finance. Joining us now for more on this Twitter saga is Wells Fargo senior analyst Brian Fitzgerald. Brian, always good to get some time with you. Let's start on the private equity angle here, Brian. Should private equity step in? How much do you think they could offer for Twitter?
Yeah, Brian, thanks for having us. Look, Twitter's board of directors is certainly in a tough spot, but we do think there's a upside to the high 50s if the board of directors engages Musk to sweeten his bid. When you talk about private equity, and first, let me say strategics are probably ruled out because of the current point of view in terms of anti-monopoly proceedings. So when you look at PE, we did some rough math trying to sketch out, how do you make the PE IRR work? We think $60 to $65 of a bid is needed. That's $40 billion of equity financing of a check and $12 billion in debt to make it work. Now, even if you assume that Twitter can overperform and garner a premium on a re-IPO scenario in the 25 or later scenario, that generates just, and we say that tongue in cheek, a 21% IRR per our rough math. So it's tricky for a sole PE player to do it by themselves. Lastly, when you look at a PE plan, it may largely adhere to the current strategy that management is pursuing. So absent of Elon's bid or absent of a white knight, the shares may be pressured unless you can do a PE partner scenario.
So it sounds like there are still a lot of unknowns here about what the outcome is going to be. But let's say that private equity doesn't ride to the rescue unless they're financing Musk's bid. And let's say that he's serious, that 5420 is it, and they don't accept it. What happens if this company now does not get bought?
Look, I think that the fundamentals are a little challenged here. They're sticking to their goal of having 315 million monetizable daily active users by 2023. In order to hit those bogeys, that's on a 4Q23 exit, they're going to have to accelerate their net adds for monthly DAU, for monetizable DAUs. They're currently running at about 5 million for the last 6 quarters. They would have to accelerate that to 12 million per quarter in order to hit that bogey. They're sticking to their 7.5 billion in revenue for 2023. So I think ourselves and the street just see those as right now lofty goals.
Brian, is a Twitter that is more pro free speech, is that good for business?
Brian, that's a great question. So we did what we're calling some Musk math, and does a freer Twitter make business sense? A freer Twitter could drive user and engagement growth, and that would help bottom of funnel DR performance advertising, but not enough, we think, to offset the brand pullbacks. Given that their business mix right now, the ad mix is 85% brand, 15% direct response. So, and that's assuming that brands are going to pull back a bit from a more freewheeling type of platform. If you, to Elon's plan, if you offset that with a cheaper and ad-free Twitter Blue, if you brought the sub price down from 3 to 2 to 1, and threw in verification, we still see 2 issues with that. First of all, we think there's limited demand, and the subscription product primarily appeals to the heavy Twitter users outbound. The second thing is that offering, if it engaged most of those heavy users, they're already generating ARPU higher than the $66 average in the US. So you take $2 a month times 12 months, that's $24. You're already, well below that $66 average on the average, not the heavy users. So, the way we did the math, we think that an ad-free subproduct would be value destructive up to, a fee of $6 a month. And that's a tough nut to get over, $6 a month times 12 months for, using Twitter.
Brian, I'm going to call out my Brian next to me for just a moment. With his trademark understatement, he said the other day that Twitter is a failed public company. And indeed, the scenarios that you're painting are not very positive ones in terms of how Twitter is going to be able to move forward. What does this company do to make more money?
It's a great question, Julie. I think first and foremost, we think the board of directors should engage with Elon and highlight a couple things. First of all, the stock was materially higher, $73, in the summer of last year, even amid the strong internet software pullbacks and valuation. Not every shareholder thinks 54.20 is a great deal, right? Twitter has been early on in some big opportunities before. First on with real-time feeds of information, short form video. They were the first in the space with Vine. That was the original TikTok, I would argue. And maybe they just hit, the business a little too early before it was ready. Mobile ad exchanges and programmatic mobile ads, they were the first there. So they have been there. It's still an important cultural and social platform, and so there's optionality there. But if you have a billionaire, willing to take this private, an investor may not get to see this asset again. So you need to weigh those options carefully. They need to. And they're working on doing this by 2023, 2025. They want to be at 50-50, brand direct response advertising. So you're canvassing the whole funnel, top of funnel, bottom of funnel. They need to get to that point of execution.
Brian, I've been doing this for a while, as have you. I have never seen someone on the board currently attack his fellow board members as Jack Dorsey did on Twitter. Never seen it before. My question to you is Twitter's board simply dysfunctional and they're going to screw this whole thing up?
Look, I think the most important thing for a board is to see where the company is executing to, make sure you have the right people in the seat to drive it. They're not the day-to-day managers of the business. Look, I think Jack may disagree with some of Twitter's content moderation policies and centralization also. He's been on the record regretting some of the actions taken to the New York Post during 2020. He said a couple weeks ago, I think it was last week, hey, I've contributed to the centralization of the internet in ways that I think were unproductive and I regret. So he may agree with some of Elon's sentiments, but we're not sure if that's an argument about the higher level, 50,000 foot level. Is this about the future of the internet and the future of democracy? Is that what he's trying to agitate about, or is it arguments about what's best for Twitter financially? Which those may not be the same thing.